Hi, I'm Batu from freefincal, and in this video, let's take a look at liquid mutual funds. So, liquid funds are essentially debt mutual funds that invest in short-term bonds. They can be bonds from issued by the government or corporates or PSUs or banks or wide range of products are available. The only constraint is that the maturity duration of those bonds should be less than or equal to 90 days. It cannot be more than that. Um, Liquid funds were portrayed as one of the safest of all mutual funds. That title, relatively, of course, that title now goes to overnight mutual funds, where the bonds have the duration of just overnight, just about 1 day. I've talked about that in another video. You can have a look at that. But liquid funds can be used for parking your money for a short term for your emergencies, or if you want money in 6 months later, 10 months later, 1 year later, you can just put your money in liquid funds. Some people even say, I don't want any kind of credit risk, therefore I want to put my money in liquid funds, they are the safest, and so on. The truth is that is not true. The risk is always there in credit risk is always there in any debt fund. Credit risk meaning that the rating of the mutual fund will go up or go down, and in a very severe case there can be an actual default where the interest payment is not done on time and there's a delay, and then that will be called a default. And if the fund holds 10% of a bond, then that 10% of the portfolio is essentially written off as zero. Therefore, there will be a vertical fall in the NAV, drop like that, big drop. It can be a 10% drop, 15% drop, depending on whatever the exposure to the bonds. We've seen that in other mutual fund categories. Of course, we've also seen that happen in liquid funds. The point I want to make is that this is part and parcel of the market. This is a very normal event. People think of only when there is a default it gets to the news, or when there is a big downgrade of rating downgrade from AAA to 7 notches down, or something like that. Then there is a big news, and but even that often means that there is a default on the around the corner and so on. But my point is that people who are invested in liquid funds should be ready to accept that credit rating changes, upgrades as well as downgrades. Of course, when there is a credit rating upgrade, for example, AA bond becoming AAA, then the NAV will little bit increase vertically up, or AAA becomes AA, then the NAV will fall down vertically by a little much, depending on the exposure in the portfolio. But my point is, I want to show you that these are normal occurrences, and this can happen in pretty much any fund. Some of the biggest liquid funds can also be affected by this. So what I have here is a table of credit rating changes that has happened over this year. Let me just push it down to this side. Yeah, that should be all right. Okay, let me keep it here. That will be safer. So what you see here is ICICI Liquid Fund, and it had held Tata Motors, and Tata Motors was a AA rated bond in July 19, and it became AA minus, one step down, and that was about 5 crores, but it's only very, very small holding, 0.0072% of the portfolio. And also, if you come down, it's a 1 month down. It's a HDFC Liquid faced an upgrade. That is, Tata Capital Financial Services was AA plus in June 2019, and in July 2019 it became AAA rated. And for the same thing happened for HSBC Cash Fund also, and also for a Franklin Liquid Fund. There was a downgrade in May 2019. ECL Finance was AA rated, and it became AA minus. And then in April 2019, Canara Robeco held Andhra Bank, which was A plus, and then it became A1 plus, which is an upgrade. So please recognize, banks are also susceptible to credit rating changes, both upgrades and downgrades. Do not assume banks and PSU funds are safe from credit rating changes. That's wrong. It can happen. If it can happen in a liquid fund, definitely it can happen in any other fund. And then you have ONGC Mangalore Petrochemicals, which is I think a PSU. So you can see the rating went from AAA in April 2019 to AA plus. That's a downgrade. And again, HDFC Liquid Fund, L&T Finance was AA plus in March 2019, and it became AAA, an upgrade in April 2019. Again, for the same liquid fund, Bajaj Finance was AA plus in January 2019, and it became AAA, again an upgrade. So these things happen all the time. For example, you can see PNB Housing Finance, again for HDFC Liquid, AAA in December 2018, and it became AA plus, which is a downgrade in January 2019. Finally, Mahindra and Mahindra Financial Services, AAA became AA plus from December 2018 to January 2019. Sorry. So the point I'm trying to make is we have to accept that these are part and parcel. These are everyday occurrences. You would not see this happening in the media because the media only projects big changes, big changes in credit rating or defaults and so on. You must understand that that's not the only time these credit changes happen. Credit risk is a daily risk. It happens. It affects all fund classes, including overnight funds, have got this credit risk. So we must get used to it. If you want to get a return better than your SBA account or better than FD on a post-tax on a tax-adjusted basis, whether it is a debt fund or an arbitrage fund, or like I told you yesterday for SBI hybrid equity fund, it happens in any fund that holds bonds. So we must get used to credit risk, and there is no escape from it. You just can't say quantum liquid is safe, PPFS liquid is safe. It's only a matter of time. They will also be affected by it. They are in the market, so they are. So don't confuse something that has never happened before with something that will never happen in future. So they're two different things. So that's what I wanted to say, and I'll catch you again in another video. Bye bye.